here this morning. Sent out the daily bias, just looking at this internal range fair value gap, quite a large inefficiency. We did also pierce the London session high. I wanted to see a change to say delivery below at least the 5-minute order block. So I'm looking at the 9:30 order block for us to displace through. We have a tiny fair value gap there, but I'm not too concerned with that. If we can displace through that and then through this 15-minute order flow as well, which would be this down closing candle or these consecutive down closing candles, that would confirm to me that we want the sell side and the IRL. And today that's the only real bias I have. It's kind of a 9:30 continuation profile, right? So 8:30 news came up, completed the market maker buy model pretty clean, filling the gap, dropping down, and then popping back up to London high. Now, normally when you have London high and low taken out by 9:30, you need to watch for low probabilities in price action, but also look for any inefficiencies that price needs to fill instead of going for ERL, right? Because both the ERLs have been taken, and obviously we most currently swept the ERL buy side, so we're looking for a discount fair value gap. There's not really a clean discount fair value gap in this range. This one's still kind of too far in premium for my liking. So you have this one in here, which if we were to pierce the sell side, I would imagine that we go back down into this inefficiency down in here. So watching how we hopefully hold this bullish Judas swing. I guess it's bearish Judas swing. I want to see this used as inversion. Same thing with this. And then eventually a closure through this breaker, which this is holding price up for now. But I do want to see it close through. We already wicked below the breaker, which normally you only want to see candle bodies and wicks stay within the upper 50%, not even a wick past the breaker. So that wick is a good sign for now. I do want to see how we continue, hopefully closing through. If we go up for data highs again, I wouldn't be interested. So just looking for shorts today, we have relative equal lows on the data lows here, which is also got my attention. Then we got all this sell side, relative equal lows, and then obviously the gap below us, which we do have some inefficiencies in here. So if price wants to bounce out of this range and then return back into short-term premium, you would expect that. But this large inefficiency, even from the close, I think there might have been news, some sort of news driver from 4:15 p.m. Also have this SIBI, actually a BISI, but watch how we potentially use it as inversion. So you'd be favoring. Now yesterday we had CPI and FOMC, right? So whenever you have a large range, typically you're gonna have consolidation afterwards. The CPI, I want you to notice, I sent out a text message out to predictions chat. Normally these large news drivers like FOMC, not FOMC, just CPI, NFP, and then any high impact 8:30 news driver, most times will have some sort of a 15-minute or 5-minute SMT. So if you go back and look at yesterday's price action, we got 15-minute SMT at the lows between YM, NASDAQ, and ES right before CPI comes out. I'm not saying you should look at CPI to trade. I'm just saying that same kind of algorithmic signature is present even on a high impact news driver like that. So if you were to trade 8:30 news, something like today, you could obviously look at the SMT there as well. On the 5-minute, just kind of finding, obviously the bias needs to go with order flow and market structure. But then once you've identified that, it should hold. I want to see this preferably use this inversion. Like I said, we did come down to fill this gap completely and the breaker. So far price action is bullish, but the bias will be bearish. So you need to see these bullish PD rays disrespected. If we come out and take this high out again, I wouldn't be super interested, because that to me would confirm the market maker buy model up to the 8:30 high. So we have this up closing candle and then the SIBI. You'd also prefer to get some speed through this breaker and then form a SIBI inefficiency on this side, trade back up into the lower portion of the breaker, and then sell back off into 8:30 lows. We are approaching macro time. So what you want to see is some sort of a bearish SMT up here or on these highs. So you go over to ES quickly. Obviously we've got bearish SMT here. So there's an inefficiency right here, which is what you want to see with the speed. So held that fair value gap pretty well. Did just pierce this low. Now the reason I'm looking at this is it's data lows. So anytime you have 8:30 news, a higher low, that is going to be normally a pretty liquid pool. especially when we form relative equal lows like this. So I guess you could actually be targeting this here, but what is this? 19607 has my first draw, I guess short-term draw, and then the sell side obviously down here. Then the IRL. The IRL is extra. I'd prefer if just the 19583 sell side is pierced. I mean, you can kind of see in here, just the market maker. It's a rough market maker sell model, but hopefully you can see it, right? Whenever you come to the morning session, should be a couple things going through your mind. One is that every single morning session will have a single or two sometimes, but most times you'll have at least one market maker model. So you go, okay, if there's every single morning session, there's one market maker model between 9:30 and 11 o'clock. We're either going to form one and complete it, or just complete one from past price action. All you got to look for, I say all you got to look for like it's an easy thing, but what you want to be looking for is low resistance liquidity that price can then target, right? If we're expecting a market maker sell model, you want to see low resistance sell side. Buy model, you want to see low resistance buy side. If you don't see that, then expect the first 30 minutes to create the low resistance or possibly form a continuation from a higher time frame. Or we're going to do something like this where you form low resistance sell side liquidity here in the form of a double Judah swing where you come down, fail to pierce these lows, you have SMT there, and then it then is ran later on. Here's 10 o'clock though. Got a low and a high put in. I'd favor if this high is never taken again. We do have a bearish order block here, allowing for a refill of this fair value gap if it needs to. Like I said, we can come up and fill this. I'd prefer if it didn't reach past that high. I guess we could turtle soup the high. So soup the high and then we'll have to watch. Now with the turtle soup, obviously you'd want to see a wick past it. That's all. Now this kind of slight closure above. If we don't get reaction the next 3 candles, like a swing high forming like this, you just want to see this displace. Then you got to start being concerned with the highs being taken. So if we have relative equal sell side, you want to see a power of 3 where it open, high, low on the sell side within time, and then close, obviously going into the rest. So we displaced through this BISI, which is what you want to see. Came up, filled the upper portion of this fair value gap, souped it, and we should trade lower and displace. You want to see this fair value gap preferably used as a breakaway. If we can close past this low, the 1004 low. Tiny fair value up there in premium of this dealing range. Tapped up into it. I don't know if you can see it. Right in there. So we got this SIBI. Obviously, if we form a short-term high in here and displace away again, this would be an intermediate term high. Short-term high to the left of it, short-term high to the right of it, and we're filling a fair value gap. So that would be a pretty strong stop positioning. Now, if we look to the left, we don't have tons of inefficiencies on the 1-minute chart, but we do have a lot of 5-minute wicks, which are inefficient. So whenever you see wicks, that's going to be high resistance liquidity too. Take a while to get down there, wicking, back and forth, kind of like this price action where it's just bouncing, bouncing, bouncing. Displacement. Screenshot this again. And you want to see a new low between 10:30 and 11 o'clock. So you see displacement through this low first. Almost. There you go. And then now just the last opportunity to the sell side. And even the IRL maybe. But now it's like, okay, we got 830 lows. That's the minimum. We got relative equal lows in here, pierced. So you could see a retracement. We have wicks in here, right? So depending on how we close on these wicks, you need to expect a short-term premium retracement. So what does that mean? Well, you have a current dealing range between the most recent buy side liquidity sweep here and the low that's formed, inefficiency in here. Now, I am watching the fact that breakaway gaps, here's a little gem, how you can identify them is if the third candle, if we're leaving a consolidation, and the third candle that forms the fair value gap prints past the previous candle. So in this case, here's your large displacement candle. The third candle prints and closes past this close, right? Does that make sense? So this low, and a closure through that. And we just left the consolidation period, and we're going towards our drawn liquidity. So you wouldn't expect this to be a Judas swing, right? If this was a Judas swing, then you'd see a full closure and probably use this as an inversion gap, and then trades up through it, taps back into it, and then we fly back up. But this is towards the draw, so this shouldn't be treated as a Judas swing. So then you can mark this out, treat it as a breakaway gap, where 50% of this preferably is not filled. So you split that in half. There's your middle line, breakaway gap. You also have a SIBI in here too. So like a stop placement at the order block high would make sense. Like it's 19,639. You don't even want to see this order block traded into. Plus you have a breaker in here, right? High, low, higher high that souped the liquidity within the fair value gap. So you have this area in price that it should reach into, or if it wants to reach into, it should hold it down. The breakaway gap, the SIBI. So this order block would never be touched. So you could actually place a stop, in this case, on the premium end of the breakaway gap. And that would be safe, at least in my eyes. And 15 minutes left. So I would assume that our IRL target from this morning will be traded into. Notice how beautiful this market maker sell model is now with this 5-minute candle just smashing through the low. Also notice 10:10, right on macro close, we take a pool of sell side. It's not random. And this should pierce the sell side. And there you go. Sell side bagged and tagged. By the way, another thing, this soup, I told you it's fine if you return to the fair value gap, soup to high, and you'd want to see a swing high form within the first couple candles. If, best case scenario on a soup, you want to see just a wick, right? Something like this. London high, the wicks are closing. Actually, this is a bad example, but if you go to the 15-minute chart, closure below the buy side. Same thing, it's fractal. So anytime we're creating a turtle soup opportunity, it needs to be a closure past. If you see something like this, where it's just slightly past it, there's always going to be some variance, and you have to allow for a lack of precision in the marketplace. So something like this, I would say, is fine because we have a bearish order block here, and the fair value gap has to be filled. So if we don't see a quick reaction lower, breaking bearish PD rate, bullish PD raise, so you have this BISI here and this order block. If we don't see that immediately, you have to start thinking, okay, now this would be a low within time, 958. We're now going to head for this high. That would be basically a catalyst for us to displace breaker. If we tapped into it, trade it up, we're going to take out this high, then this high, trade into this fair value gap, and then take out this high. And that just comes with the experience of seeing it so many times, because now this is low resistance liquidity, right? In the form of buy side. So it makes sense for us to just continuously pierce those highs. But immediately after we got the soup, it trades and displaces through this entire fair value gap. Then you can trust, okay, now this would be a good shorting opportunity. You have a fair value gap, slightly in premium. Candle buy is all holding that. Also within macro time, 10:07. Boom. Right, you also have a 5-minute candle printing bearishly on that. 9:55, printing bearishly. 9:50, printing bearishly. SIBI in premium. SIBI in premium. There's two opportunities. Boom. All right, I mentioned it earlier this week. A refining factor in the ATM model, or really in any model you can use, is only by using fair value gaps that print in the direction of price that you're looking for. So if you're bearish, you want to only be using SIBIs. That means you're excluding inversion fair value gaps entirely. That means you're going to miss trades. But if you're only looking for SIBIs when you're bearish and only looking for BISIs when you're bullish, that's already it's tipping its hand towards you. You already have displacement and a strength in price to reach its target. Therefore, getting in line with an order flow, getting in line with just a retracement, and then returning back into, by the way, I mentioned earlier on stream, you have inefficiency as on 1 minute over here. That's why we're slowing down. So look for high resistance within this area where price has to come back and forth, filling it, right? Back and forth, back and forth, back and forth, and then eventually tapping this and probably retracing back up. So that's why we're slowing down a little bit, okay? Anyways, if you have a order flow already printing in your favor and you retrace, it's a higher chance it's going to reach into it. Now, what do you need to look for if there's a SIBI and we're bearish? One of two things, either a breaker or a premium fair value gap, right? That makes it so much more simple. If you are trading a SIBI, that's a down closing candle, meaning you're bearish in this case. It needs to be, the SIBI either needs to be in premium if you're trading, or there needs to be a bearish breaker. There's your IRL, by the way. Fantastic PA. Sorry, just sending that to predictions chat. So if you have a SIBI, you're only going to be looking for a premium or a bearish breaker, right? Or if you have a BISI, there needs to be a discount of the daily range or a bullish breaker. And obviously, if you're trading into a SIBI, there needs to be a sell side target. And if there's over here, you're going to be using a buy side target or some sort of a upper portion, right? Premium to discount relative. We'll say premium. This will be discount below the marketplace, above the marketplace. But that'll make your entries so much easier. You can even refine this further down. If there's a premium fair value gap, most times there's going to be a bearish order block that price is going to reach into, plus the premium fair value gap. If it's a breaker, it doesn't need to reach into premium. That's why it's two different things. If there's a discount, you want to see a bullish order block to refine down your entry. This will be so useful because this is the only two entry techniques you need in price. It'll get you in 90% of the high probability moves. Sometimes it won't, right? Sometimes it'll create an inversion fair value gap, trade into it, and it leaves without you. That's tough. Suck it up. Like, you're going to miss moves and you're not going to have the best exits and you're not going to have the best entries. It's part of it. You only need to be slightly better in your wins than your losses, right? Just slightly. If you're just 1% better, if you can take 51% as your wins to loss ratio, right? You have a hit rate of 51%. You're profitable. All you got to do, look for 2 to 1, and there, your goal is met. You're making money. Demo money. So the times where you miss a fair value gap entry or you miss a 60-point run, instead you took off 30 points, it's not a big deal. You're in here to get in and get out. You get in, if your setup's not there, it doesn't matter. You're paid to show up every day and do the same stuff. You're paid on your decision making, not on what trades you take, just your decision making. If your setup's not there and your decision to follow your rules is to, okay, I'm not going to take a trade, so you get paid for that in the long term. You're not going to get paid that day because you didn't take a trade, but in the long term, you'll get paid by it. But these are the only two you need, right? And if you look at today, what do we have? Well, this inefficiency is a SIBI. We have a bearish bias. So, okay, what do you need to do? Well, if we go back in the replay mode really quickly, you see it print 1, right? 2, there's your fair value gap. Is there a breaker? No. There's no breaker in this price action. This is a mitigation block, but it hasn't even closed past it yet. So what do you need to do? Refine this down. There's your premium to discount. Is it tapping into premium? Displace it again. Does it reach into premium? No. There, in premium. Shorting opportunity, stop goes above this high or this high, doesn't matter. There's your entry. 20 points, already at that low. Another 36 points there, 55 points there, 83 points there. It's not a big deal if you don't get the entire range. You only need like that first partial opportunity. Then it displaces. That's your 20 points. Again, fair value gap in premium. Also notice how we also had a order block here that price reached into with the fair value gap with premium, right? Trades into this fair value gap in premium, and then sells off. You know the rest. But that's the only two you need. So these are the entry techniques. Exit techniques will be drawn liquidity and time, right? Time and price, right? And then all you got to do is just figure out what are the different things on the different time frames that you need to see in order to feel confident that you're going to get in. For me, it's an hourly or 15-minute draw on liquidity. I need to see some form of an SMT. I need to see 5-minute order flow closing in my direction, and then a 1-minute entry, which would be this, right? So today we got all that. You got the SMT, 5-minute candle printing bearishly on the 950 candle. Really the range for the ETM model, if you're going to use the ETM model, the range you want to be using most times, I say most because occasionally you won't get it, especially if there's 8:30 news. Sometimes you get displacement and order flow into 9:30. But I'm saying most times the candles you want to be looking for is at 9:45, 9:50, and 9:55. You want those to somehow print in your direction of price and support the order flow idea. So in this case, like this 9:50 candle, although it was printing bearishly, we're still holding this order block. As soon as that 9:55 candle comes down, smacks through that order block, now you can start looking for shorting entries, and you got a couple in here, right? For you, it may be different. For you, it may be, I'm only looking for a market maker buy model. Well, why would you do that? Just because it narrows down your focus and price, and you won't get an entry every single day, right? If you're only looking for market maker buy models, every single time you get a sell model, you have to say to yourself, okay, I'm not going to touch that. So create some sort of a model that preferably happens every day, but you don't need to take it every day. Or you make a model that doesn't show up every day, and you then completely disregarding the days where it doesn't show up. And that'll create good discipline and patience, and also promote your decision making, right? You get paid on decisions that you make. If you're over leveraging, is that a good decision? No, you're not going to get paid. You may get paid short term. You may get a dopamine hit. That's your payment. But that funded account, that eval is going to be gone within the next week or so. But then as soon as you kind of just let go and be like, all right, I'm going to just follow my rules. I'm not even going to worry about the money. I'm just going to sit here and take the right decisions. If you do that for 3 weeks, 2-3 weeks, you'll see a massive improvement, especially if you're journaling in price. So come to the markets before you even look at it, or while you have the charts pulled up and before even looking at a setup, mark out, write down, how do you feel in price? What's your expectation? Are you carrying over baggage from the previous week or the previous day? Is there a loss like you took yesterday? Do you still feel that mentally where you're coming into the market today thinking, I need to get that loss back? If that's the way you think, normally it's not going to go well, and you may take poor decisions, and that's sometimes part of it. Being self-aware is the first step in being disciplined. If you don't know what you're doing, how are you going to be disciplined in fixing it? And then obviously post-market, once you're done with price action, done with looking at everything, review how you feel, what was your expectations, all the stuff in that screenshot there. And then in tandem with the post-market journaling, you need to have screenshots of price. Every single day you should be screenshotting, going back, deleting everything on your chart, and then remarking it up like you saw it in live. So like later today, I will completely just erase everything on my screen, go from the hourly, mark that up, 15-minute, mark that up, 5-minute, mark that up, 1-minute, mark that up, and screenshot every single one, and then post it into my Notion. So then it kind of tricks your brain into thinking, okay, I saw this happen live. So the next time that something similar to this happens, because I think no 2 days will be exactly the same. They'll be very similar, but there's going to be differences in them. Next time I see that, I'll be more confident in either staying out or managing my stop better or getting in properly. And all that stuff will help you improve. If you're just waking up or pulling up the charts between 9:30, you get to your charts right at 9:28 and you're frantically trying to pull everything up, that's not going to help you. And then closing the charts out at 10:30, 11, and then never looking at it again, you're missing out on improvement. You're going to keep doing the same stuff. You're going to improve at a much slower rate than if you were to just do the extra work that's necessary. Showing up when no one else is watching. I'm not going to be streaming. No one else is going to be telling you to backtest or take screenshots. But you've got to just do it. Because if you want it bad enough, you'll do what it takes to get there. I'm just yapping now, but it's all the important stuff that at the end you'll get to sit through. So take care of the rest of the day. Hopefully you learn something in price action. Get outside if you can. Enjoy the sunshine. Take care of yourself. and we will see you guys soon. Peace.